So I'm going to talk about what we need to see in order for the economy and the markets to continue growing. So employment strength, right? So for 2019, by far, the consumer was the engine of both the economy and the markets, right? So unemployment at 3.5% over the last 2 months, 50-year low. For December, there was 145,000 jobs added, which was below the forecast of 160,000, but still very strong. This graph basically shows you how many jobs need to be added to keep unemployment at that low interest rate, unemployment rate. So 3.6%, you need to have at least 107,000 jobs added. So this is what we're looking at constantly. Is this something that's sustainable and that we can still have that 145, 150,000 jobs added? You know, just because that number didn't hit the expectations, quite often it can be adjusted up in out months, so we still may get there. But this is what we're looking at, and if we see those numbers decline and we start hitting under 100,000, you know, that would be a concern of ours. But if we can keep over that 110,000 in the 150,000 range, we're all good. The next area is wage growth, right? So if you're an employee and you got wage growth, this is a real positive thing. This looks at high wage industries, which is the orangish line, middle wage industries, which is the red one, and then the blue line is low wage industries. And I have two circles here. One is in 2010 to 2011 and 12, you did have wage growth, but it declined quite dramatically. And in particular, the low wage earners really took a hit during that time period. Whereas you can see right now in the last year and a half, you're still having wage growth, but the low wage earners are really doing much better. They're having higher wage growth. And that's really important because those individuals, as they get raises, they're more likely to spend their money into the economy, which is a real positive to see. Americans are saving more. This is a great thing. So this is looking at the savings rate over the last 30 plus years, 40 years. And you can see back in 1980, people were saving 10 to 12%. That's fantastic. That puts people in a really good spot. If there's a problem from their own personal situation, they have savings. Also from a retirement perspective. You can see that declined over the next 30 years, all the way down to the Great Recession. And over the last 10 plus years, it's been moving up. And again, that's a real positive sign for the economy and in the markets. In case something does happen, people are in a better spot and they're in a better spot to retire. Also debt, right? So right now we're at historical lows of debt versus disposable income. This is what this is looking at. As of the fourth quarter, we're at 9.7%. That is great. You look at all the past 40 years, it hasn't been that low. And look at where we were in 4Q07, right? Right before the Great Recession, we're at 13%. Obviously, people taking on way too much debt at that point. And again, this is a good situation that people can continue spending and they're not funding their spending with debt. Inflation continues to remain tame, right? So we talk about inflation in most of these meetings because it's important. If inflation is at 2% or below, and that's really where it's trending, which is that black line right there, it's way below where it was in the 70s and 80s. If it's in the 2% or below range, what that does is it allows the Federal Reserve to be accommodating, meaning keeping rates low, which allows people to be a little bit more aggressive with their money, right? If you're only earning 0.01% at a bank, you might say, you know what, I'm going to go ahead and be a little more aggressive with how I invest this because I want to earn something on my money. So having a low interest rate is really valuable. From a borrower perspective, is really valuable. So as long as that remains low, the CPI, Consumer Price Index, that's going to be a real positive for the overall economy. Housing starts are heating up, right? So I think everybody in this room has probably bought or sold or built a home. You know, when you're going through that process, you're spending a lot of money on different things. That's a real positive to the economy. You can see this is both housing starts, the red and the blue line. It's been trending upwards since 2015, but just from 2018 and 19, as rates rose, that started to change, right? You had a decline in that. And then as rates declined last year, it reversed course, right? Started to go back up. It's really hard to have a healthy economy if you have a declining housing market. The housing market generates so much spending. So to see it change course like that is a real positive. And, we get a question quite often, is there a housing bubble? And I think this graph really helps to explain that it really is not the case, right? So again, this is housing starts, but for a longer time frame. You can see that in the 2000s, all the way to the peak of 2007, there was a lot of housing starts, right? Yeah, you can tell that looks like a bubble, a real sharp decline. Now we're just digging out of the hole. And you may not see it here in the Albany region, but from a national perspective, there's actually a shortage of homes in a lot of these big urban areas. They're not making enough homes, which is a real problem. So we're starting to come back, but I don't think we're anywhere near a bubble concern with housing. And I think this slide is really important. We get a lot of questions about student debt. What does that mean to the economy? How can it be a problem? And in general, I think it'd be difficult for that student debt market to have a bubble and pop. And I don't know what that would impact in particular as far as banks, but it definitely is a drag on the economy, right? So if you have these graduates coming out of school, both graduate school and undergrad, and they have a lot of debt, that's going to limit their ability to buy homes. And this is looking back since the early 1980s at the median age of homebuyers. You can see it actually has been trending upwards, which makes sense, right? People are delaying marriage and whatnot. But in the last 10 years, there is an 8-year difference, right? It went from age 39 for the median age to all the way to 47. So this means people are really pushing off buying a home to a much later age. And I think a lot of it is they don't have the money, right? If you need a down payment of 10 or 20%, you're paying off student debt for the first 10, 20 years. So I think that's really what's driving this. And this is that drag that I talked about. And you can see a little bit in this graph too. So what this is looking at is GDP growth for the last about 10 recoveries. And you can see a lot of those recoveries are grouped together, right? Similar growth pattern with rates of growth of 3, 4, 5, 6%. We're the bottom blue line. That's the most recent recovery. So yes, we are in the longest economic cycle recovery ever. We're going to be on 11 years coming up here. Same thing with this bull market. But remember, we came from really low lows, and our growth rate has been more 2.5%, 3%, right? This new normal. And that is kind of standard coming out of a financial crisis, but it's also a function, I would say, of all that student debt out there that is limiting some of this growth, right? They're paying off debt. They're not going out and spending all that money. And then finally, talking about global economic indicators, right? So this is the United States, it's the blue line. The OECD is the orangish line, and the red line is China. This is looking at forward-looking economic indicators, right? So this is what we look at to say, hey, are there any things that we see in the horizon that's a concern? And what you see is three different kind of patterns there. Back in 2011, there's a decline, right? You can see all those decline. That was a debt downgrade by the S&P of the US debt, right? And there was a real impact to the economy for that. Then it came back. Then in 2016 and 15, that was when the oil market completely crashed. And you can see it dropped down for that, and then it came back. And then more recently, last year, with the trade discussions and wars, it declined. Now the question is, does that trend continue? But you can see already it's starting to come back. And that's something we're going to be closely watching. Is there a negative trend to these leading economic indicators, or does it trend positive like it did in the last two periods? So let's talk about business investing, right? So I talked about how important the consumer is to the economy and the consumer spending. Well, the question is, where do businesses stand? And this is business investment over the last 3 years. And you can see it really peaked there. You had the tax reform bill that gave a lot of cash to corporations. They reinvested that back into the business. But the last 2 quarters, you had a decline in business investing. And that is a problem, right? You need businesses investing back into their business. And I think a lot of that is because of the uncertainty with the trade wars. So if we starting to get some resolution in that, instead of them escalating, you have phase 1 deal, and if you can get a Brexit in place, this should hopefully improve. But again, this is something we're looking at, and it's important that it comes back. The other element is CEO confidence, right? So you can see I've circled there. This is just, in general, CEO confidence. It can go up or down, but it's kind of declining downwards. Again, this is really about the uncertainty with the trade discussions and trade war. If CEOs say, hey, now that's kind of behind us and it looks like there's some sort of path forward, these CEOs can make decisions both here in the US and overseas, and hopefully that's going to swing back up. Again, something else we're looking at as far as the direction of CEO confidence. Small business hiring, right? So small businesses are very important to the health of the economy. Having those small businesses really going out and hiring people is important. We're seeing a little bit of a decline down in that. But again, if you look at it, that happened in 2011 and it happened in 2015 and 16. So if it's following this trend, which is just short term because of the uncertainty in trade, hey, this could come right back and everything's going to be good. But we're going to be watching this to see which way it's going. I think this is a very interesting graph. So the red line here is the Wilshire 500, which is an equity index. The black line is the unemployment rate. And what you can see is back in the 90s up to 2000, and then the 2000s up to the Great Recession, those two crossed paths, right? And we've had the same thing more recently where they've crossed paths. Now, again, this can keep going on for a while if some of these great economic indicators keep being positive. But this is something that we're watching, and we'll be making decisions based on which direction we see it maybe change. I talked about manufacturing, right? So this is looking at both manufacturing, which is the blue line, and non-manufacturing, which is called the service index. So if you're above 50, which is that line right there in the middle, that means the service industry or the manufacturing is actually expanding. So you see a lot of times it's above, but there's actually two different times where the manufacturing dips below 50, right? Again, back in 2011, 2015 and 16, and more recently. So again, the hope is here that we have it kind of converge back together like you did in the last two periods, but that's going to be something that we're looking at. With the trade deal in place, manufacturing should hopefully pick up. This is something you've seen certainly in the Midwest with some of the weakness, but this is something that we'll be looking at to kind of gauge as we move forward here. And then finally, this is really one of the most important slides, right? In order for the markets to move forward, earnings have to grow. Current earnings and future expected earnings have to grow. We've had two time periods where you've had this dislink between the market, which is the blue line, the S&P 500, and corporate after-tax earnings, which is the orange line, right? So in the 90s and in 2007, you had this divergence. You're seeing it now. Really, again, for the market to sustain and go up from here, we're going to need to see earnings growth. We're just starting to see the earnings come in for the fourth quarter, and what we're seeing right now is positive, right? So you need to see revenue growth, which leads to more profits for these corporations, and this is going to be something that we're going to be watching closely. So to summarize real quickly, labor and consumer markets, really, again, for 19 and 20, that makes up 75% of the GDP, gross domestic product. It's going to be very important for the growth to continue. If inflation remains low, the Fed is more accommodating, and there's no asset bubbles that we see, that's going to be a real positive for things. Businesses need to increase capital spending, right? So they need to reinvest back in their business, both here in the US and overseas. Global manufacturing, we need to see that pick up, right? That's going to be very important, and the hope is that phase one of the trade deal, that's going to be the pathway to get us there, along with the new NAFTA and Brexit. And then finally, as I mentioned, corporate revenue needs to increase, and profits need to go up from there in order for the markets to go higher.